Thank you, everyone, for joining us this annual update for ASUs effective for this upcoming busy season. My name is Michael Hoos. I'm a director in our professional practice department, and I am based out of the Raleigh office. And let's go ahead and jump right into our learning objectives. So by the end of this course, hopefully you'll be able to detail the newly effective ASUs for 12/31/2023 reporting period. And we'll go over some of the ASUs that were released in 2023. We're not going to have time to go over all of them, and not all of them are, pertinent or effective for you. Hopefully you'll be able to understand how these ASUs will impact your financial reporting. Before we moved on to our first polling question, I do want to point out that, there's about 13 ASUs. We have about an hour, so I can't go into depth for all of the ASUs. So I'm only going to give, lip service to some of the ASUs. In addition, not all ASUs, it's just the nature of these type of webinars. They're not all going to be applicable to you. Some are more niche, like financial institutions or insurance entities. So, please be patient through that. And I'll try to focus most of my effort on those ASUs I think they're going to be, most impactful to the broadest range of listeners. And so with that, let's go into our first polling question. And so our first polling question is, has your organization already assessed the impacts of the latest ASUs? Right? So your options are, yes, we have everything under control. B, we've started but need some help and guidance. C, no, but we're going to start in the next few weeks. D, we're not sure what to do. Or E, I'm just unsure of what you're asking. So go ahead and make sure that you answer your polling questions so that you get your CPE credit. We'll give people a few seconds here just to answer. And we will close out the poll. And so obviously, hopefully by the end of this ASU webinar, you guys will be able to, know what to do and have a better plan forward. So let's jump right into the ASUs that are effective for private entities for this coming year end. All right. We've got a number of them here. The biggest one going to be the first one, which is ASU 2016-13. Now, I haven't listed on here, the first asterisk means that I'm not listing like ASUs that are, codification improvements that aren't expected to change a lot of current practice, nor am I including any ASUs that defer effective dates. And then also, if an ASU has multiple ASUs that amend it, then I'm just including the original ASU here. So there's really just, 5 main ASUs that are going to be effective for private entities. And the last thing I'll point out here is the double asterisk. That's because sometimes guidance is applicable to private companies and SRCs together, and all other public companies separately. So some of these ASUs are also applicable to any public companies listening today. So the big one's going to be 2016-13, and so let's just jump right into that. But before we do that, I do want to point out, I'm not going to talk a lot about 2017-04. That's the ASU, obviously it was released a while ago in 2017, that simplified the testing for goodwill, right? And so everyone's pretty much adopted this already. If you recall, back in the day, you would have like 2-step goodwill impairment calculations. Well, that just simplified it so that it's just really 1 step, right? And so everyone's adopted that. I don't think it's worth your time going over that ASU. So let's talk about the big one. Now, this isn't a CECL webinar, so I'm not going to go into great depth, but because this is one of the more impactful ASUs, I will go into it more in depth than some of the others. So ASU 2016-13 introduced what we call CECL, or the current expected credit loss model, right? So the first bullet point here, current GAAP generally delays recognition of impairment for credit losses until the loss becomes probable. That was called the incurred loss model, right? So what this ASU does is it eliminates that probable initial recognition threshold, and it requires an estimate of the expected losses over the life of the instrument to be recorded at the time the instrument is initially recorded. So before there's any kind of indication that the counterparty might not fulfill their end of the obligation, right? That the receivable might not be paid. It doesn't matter. It's recorded. Any expected losses over the life of that instrument is expected to be recorded at the time the instrument's initially recorded. Moving on to the next bullet point, CECL states that an entity shall not rely solely on past estimates, right? So you have to update it for your historical loss information. It should be adjusted for current conditions and for a reasonable and supportable forecast, right? That's one of the bigger changes there. And then also the other big change here is it requires an entity to evaluate financial assets that share similar risk on a collective basis. So we've obviously, have a lot of practice insight. We've helped a lot of entities with this. And so there's a few things that we've noticed. The first one being this first bullet point, which is that there's a common misconception that it only impacts financial service industry. That's not true. The most common way it impacts almost all entities is through your trade AR allowance, right? And the practical impacts is that it's likely going to increase your AR allowance, because think about it, you now have to start recognizing not just when losses are incurred, but when the entire amount that you expect to lose over the life of that instrument initially. So it's going to increase your AR allowance just on that fact alone. Also, some entities have historically not really had an AR allowance, and now they probably will. The other big practical impact is that using that forward-looking information, that's something that's new to us. And then, of course, as I spoke about in the last slide, having to analyze things on a pooled basis if they share risk characteristics. And then the last bullet here, which is somewhat surprising maybe, but we've seen a lot of difficulty with computing the historical loss rate. So I'm going to go into that in a little bit in depth to kind of show you what I mean here. All right. So what we have here is the loss rate method, and there's really two methods for trade AR that's used, right? So the guidance will allow you to have, many different methods that you can use at your disposal for computing your historical loss rate. But for trade AR, which is going to be the most impactful for most of you, there's really just two main methods that are used. It's the loss rate method or the aging method. So the loss rate method is the easiest method to understand, right? So you really just kind of start off with your, year-end AR, right? And then you would have a historical period that you would look back on, like say the last 2 years or something. So the length of your historical look back period and the exact years or months that you look back on, that's up for debate and judgment for you and your auditors to decide. But you go and you look at that look back period and you say, what are all the historical write-offs during that period, and what are the historical credit sales, right? And that's a simple math, right? It's simply just taking those historical write-offs over the historical credit sales to get a historical loss rate, okay? And then you simply just apply that loss rate to the current period ending AR, and that's your starting point, right? Then you would have to adjust it for, your current conditions and your reasonable and supportable forecast. Now, what I'll say here is that that 2.5%, if you should really probably think of it as a floor, right? Because if you really think about it, if you've historically lost 2.5% in this case of your receivables, right, or your credit sales, I should say, then at year end, 100% of all your credit losses, unless you've cleaned up AR at year end and wrote off a bunch of things, 100% of your AR losses or of your credit losses are going to be in ending AR, but not 100% of your credit sales. So really that 2.5% should probably be a floor, right? So in some ways you can maybe make an argument that the loss rate method underestimates your allowance, right? But the next example that we'll go over, which is the aging example, right? That's the aging method of doing it. That has the potential for even more mistakes to be made when people are computing their historical loss rate. So this right here is straight from the codification. It's an example they include. We're not going to go over the example itself, but what the issue is that the example that they give in the codification, it just states what your historical loss rate is by each aging category. It doesn't tell you how to compute that, which is unfortunate, right? And you'll see in this detailed example we're going to walk through how that can result in a pretty significant understatement, right? So again, we're going to start off with our current AR balances. In this case, we got $10,000 that are outstanding in AR. You can see the categories listed on your screen there, right? And so what I've seen in practice is that a lot of folks will go and they'll compute, well, what were my write-offs for each of these categories, right? So for example, let's say that, for receivables that were not past due at all, 0 days past due, we ended up writing off $50 of them historically, right? During this, whatever historical period we're looking at. And those were 1 to 30 days, we wrote off 100, right? So that's our historical experience of when we wrote things off and what aging category the related receivable was in. But the problem with this one is not one, but the biggest one is it's just the write-offs are under the incurred loss method, right? So obviously you probably didn't write off a lot of things that were 0 days past due, even though that maybe historically you've had 2.5% of all AR that is written off. So you're kind of already starting off by applying the incurred loss method when you calculate your aging this way, right? And so they'll go and they'll take the write-offs by these categories and they'll compute their historical loss rate by each category. As you see here, the math for the first category, 0 days past due, is simply just taking your historical write-offs that occurred for receivables in that category over your total credit sales. And so they would say, okay, in this case, 0.05% for AR that's 0 days past due. Okay. Now, then they'll take that percentage and they'll just apply it to the current period outstanding. And that's how they'll come up with their CECL provision, right? Now, the problem with that is that those percentages are, again, based upon write-offs that were written under the incurred loss method, right? So in this case, if you did the math, you'd end up with percentage of total AR of only 0.15%, right? And that just doesn't make sense when you think about the fact that the historical write-offs are 2.5%, right? So you've probably understated and you've kind of applied the incurred loss method to the expected loss method by computing your historical loss rate that way. So let's show you how you probably should be doing it, right? If you're going to use the aging method, right? So if you're going to be using the aging method, you have to essentially construct a aging for all credit sales over whatever your look back time period is. And it'll make more sense as we walk through this, right? So this first table, you're constructing an AR aging. And so you start off with total credit sales during the historical look back period. And then what you do is you say, okay, well, how much of those historical credit sales during whatever look back period I'm using were paid before they became past due at all? So in this hypothetical example, 40,000, right? And then you would result in a closing balance for that aging category that would then carry over to the next aging category, in this case, 1 to 30 days. And you'd keep doing this back and forth until you got to the point at the very bottom of this first table where you end up having, 2,500 that were never collected, right? And then what you do is you construct this quasi-aging where you start off with your $100,000, your total credit sales for the period. That would be in your 0 days past due category, if you will, right? And you would just do that for each of the different categories from the table above that we could calculate, right? So that's the first part that's a little not necessarily intuitive, right? And then the second part that's not really necessarily intuitive is, okay, well, what number do I use as write-offs for each of these categories? And that's the part that trips up a lot of folks, which is, well, then you should be using the overall write-offs for all of your credit sales during that period for each of these different aging categories, right? And the reason why that makes sense is because in that first, $100 million of credit sales, we know that there were, and these are in millions and not thousands, like the example is just to save space on the slide. So the first 100,000 of credit sales, there was 2,500 in credit losses that were in there. So we know that 2.5% is your losses without even considering your overdue status, right? And so then the next thing is, okay, well, the next category, 30 days later, after we've collected, say, 40,000 in our hypothetical example, we're left with 60,000, right? And so you know that of that 60,000 that are now, reached the 30 days past due or greater, that 4% or 2,500 of those were ultimately written off, right? So then you carry forward with this logic and you say, okay, well, great. 30 days past that, the balance is 30 million. And we know that still 2,500 of that was written off, right? And so you continue this process. And that's why you end up having the same $2,500 for each of the categories that you compute, right? And it makes a lot of sense because if you look here, the historical loss rate for the 0 days past due, right, is 2.5%. That makes a lot of sense when you think about it because you're saying that your historical loss experience is that no matter, not even considering how old something gets, that you lose 2.5% of your receivables, right? So that should be your floor. That should be like the beginning number, and it should increase as the receivable gets older, right? And so then all you do is you simply apply these percentages that we compute in our quasi-aging, and you compute that simply multiplying by the current period outstanding balance. And you would come up with, in this case, a total allowance of 4.58%, which makes a lot of sense because your 2.5% historical loss rate is the floor because 100% of credit sales that won't be paid are in year-end ending AR. So you're going to have a higher rate of allowance on your AR than you will have in your historical loss rate over all credit sales. Another thing that we see in practice is a lot of people say, well, I haven't experienced any historical losses, so I can have an allowance of 0. Well, in the CECL ASU, it gives an example of when you might have 0 allowance, and it uses U.S. Treasury securities as an example. And the example says that it's not intended to only be applicable to U.S. securities, but the list of why you can have 0 allowance kind of contradicts that. Like, for example, it mentions the ability to print currency, right? So what I'll say is that most interpretive guidance would suggest that, it would be challenging for an entity to establish a 0 loss expectation, even for receivables that are due from highly rated customers. Now, to be somewhat coy here, there is some precedents that I've seen for, recognizing a immaterial amount of AR allowance. Now, this is what we've seen in very limited facts and circumstances. And this is, Michael Hoos and Cherry Bekaert speaking here. This isn't something that's in the codification. But if, you have no entity-specific write-offs history, if current conditions and reasonable supportive forecasts don't indicate any change, if the receivables are due from large, stable, financially sound industries like oligopolies, and if there's multiple examples of comparable companies that have immaterial receivables, right, then you might be able to make an argument that, okay, maybe it's not 0, but it's an immaterial amount. And for example, I've seen this happen in like the pharmaceutical industry because most of the receivables are from what they call the big 3, which is kind of an oligopoly of pharmaceutical distributors, right? The next thing that we've seen kind of trip people up with CECL is the fact that it's a modified retrospective transition, right? So that means you have a cumulative effect adjustment to your beginning retained earnings. So what that means really is people don't realize this is, hey, I have to compute an allowance under CECL at my current year end, and in theory under the beginning last year's year end, right? So there's kind of 2 allowances you need to think about. And then the last thing that I think is worthy of noting that we've seen in practice is we've seen some folks argue, well, I have credit enhancements. I have AR insurance or something like that. So I don't have to consider CECL because it's all covered by my AR insurance or some sort of credit enhancement. And what the codification will say is that you do not consider, when you're computing your CECL allowance, you do not consider any credit enhancements that are freestanding. Now, what does freestanding mean, Michael? Right? Well, freestanding, basically, this image that you see here, it means that it's legally detachable and it's separately exercisable. So the way I try to explain it to clients is, if I have an AR and I sell it to a third party, if whatever credit enhancement follows that AR to that other party, well, okay, then you can probably consider it in your CECL allowance calculation. If that credit enhancement, such as AR insurance, does not follow that AR when you sell it to a third party, then it's likely freestanding, which means that you should not consider that in your CECL allowance. Now, that will cause some consternation for some folks. And so the way you should think about it is this: you're calculating your CECL allowance separately from any kind of AR insurance or freestanding credit enhancement, and you would recognize an allowance. Then you would separately analyze your freestanding credit enhancement, and that would be, you would record a receivable for that. And so you would not net the two, but you would be able to recognize an asset on the books that would counter the allowance account for your AR in that situation. So those are some of the things that we've seen in practice with CECL. We're here to help you if you need help and some of the things I've said scare you. Hopefully not, but if you do, we're here for you. This is effective for all entities that are not public business entities for fiscal years beginning after December 15th, 2022. So hence why we're talking about it. It's effective for this 12/31/23 year end. And again, it's a modified retrospective approach, right? So you have 2 periods of allowance that you really need to calculate. And so with that, let's go ahead and move into our second polling question here. Let's make sure everyone responds to this polling question and gets their CPE credit. And that is, CECL only applies to financial institutions. CECL is not expected to change current practice for most entities. Is this true? Is it false? What do you guys think? We'll figure out how many people have been paying attention thus far. Give people a few seconds to answer this. All right, well, hopefully everyone's had some time to answer that. So the correct answer is that yes, CECL applies to all entities. It's most impactful to financial institutions. However, those folks, even with trade AR, will in theory be impacted by it. So let's move on to the next ASU that's effective for this coming year end for private entities. And that is ASU 2022-02, which deals with troubled debt restructuring and vintage disclosure. Okay. So what ASU 2022-02 does is it eliminates TDR accounting for creditors. So rather than applying the recognition and measurement guidance for TDRs in ASC 310-40, an entity now would apply the loan refinancing and restructuring guidance in ASC 310-20 to determine whether a modification results in the creation of a new loan or a continuation of an existing loan, right? And again, I want to emphasize here that this is just for creditors. So TDR guidance for borrowers still is in existence, okay? It also enhances disclosure requirements, right? So it eliminates some of the disclosure requirements around TDRs, but then it adds other disclosures around write-offs. So for example, vintage disclosures, which are applicable only to public entities, okay? And so vintage disclosures, what are those? Well, prior to this update, public business entities were required to disclose gross write-offs by class of financing receivable and security type. And investors complained that disclosing gross write-offs by year of origination or vintage would provide more useful information than gross write-offs by class and security type, because disclosing by year of origination or vintage allows investors to better understand changes in the credit quality of an entity's loan portfolio and their underwriting performance. So for public business entities, 2022-02 requires that an entity disclose current period gross write-offs by year of origination or vintage. ASU 2022-02, it's effective for all entities that have adopted CECL. for fiscal years beginning after December 15th, 2022. And then for those entities that have not adopted CECL, it's effective upon adoption of CECL, which we just learned in the previous ASU that it's now required. CECL is required in this current year. So that's all to say it's effective for all entities this year, right? Early adoption was permitted and the transition method was prospectively, but you do have an option to apply the TDR changes using a modified retrospective approach. Let's move on to the next ASU, which is ASU 2022-04. And that deals with disclosures for supplier finance programs, right? So a supplier finance program, which is commonly referred to as like reverse factoring or payables financing or structured payables ranges, it goes by different names. It allows a buyer to offer its suppliers the option for access to payment in advance of an invoice due date, right? But this payment's paid by a third-party finance provider or intermediary. So the way it typically works is that a buyer will enter into an agreement with a finance provider or intermediary to establish such a program. Then the buyer will purchase goods and services from its suppliers on credit. Then the buyer will notify the finance provider or intermediary of the supplier invoices that are legit, confirmed as valid. Then the suppliers can then request payment from this third-party finance provider or intermediary for those invoices that have been confirmed as being legit. And then they can receive their payment prior to the due date if they so wish, right? And so stakeholders observed that there was a lack of transparency about these programs because there was no explicit disclosure requirements that it's specific to the programs and that a buyer could present these obligations covered by these programs on balance sheet items that were like, for example, accounts payable. It wasn't separated out. And so as a result of 2022-04, buyers in a supplier finance program must disclose sufficient information about the program to allow users to understand the program's nature, changes to the program, potential magnitude, and activity under the program. And so a buyer would disclose quantitative and qualitative information about key terms, such as payment terms, assets pledged, and security, that kind of thing, and the outstanding obligations, right? Where those obligations are presented on the balance sheet. And then they'd have to include a roll forward of those obligations. So this ASU is effective for all entities beginning after December 15th, 2022. So this coming year end, and except for the roll forward requirements, which are effective only for fiscal years beginning after December 15th, 2023, right? So next year. Early adoption was permitted, and it is permitted for these roll forward requirements if you'd like. The transition method, it's retrospective, except for the roll forward requirement that should be applied prospectively. So let's move on to the next ASU that is effective for private companies for this coming year end. And that is ASU 2022-06, right, which is an update to 2021-01. And this deals with reference rate reform. Now, I'm not going to go into depth on this simply because, 2021-01 it's something we've gone over in previous webinars and hopefully you all are familiar with. But I'll just say that, a number of years ago, there was, a LIBOR scandal where a lot of banks were manipulating the LIBOR rate to their benefit. And so LIBOR was eliminated. The USD LIBOR ended, I think, June 30th of this year. And so it's been replaced, at least in the US, by SOFR, or the Secured Overnight Financing Rate. And what ASU 2021-01 did, right, the ASU that's being amended by the 2022-06 ASU, what it did is it basically said, hey, a lot of folks were worried that, hey, if I'm going to say I have a loan or a hedging instrument that had that had LIBOR, and now I'm replacing LIBOR, does that mean I have to go through debt modification, extinguishment, analysis? Does that mean I have to reevaluate the effectiveness of my hedging because I'm replacing the benchmark rate that's used in these instruments? And so what ASU 2021-01 did is it said, if all you're changing is just replacing the benchmark rate, then you don't have to go through and do these analysis like determining whether or not there's a debt extinguishment or modification or whether your hedge accounting is still effective. And all ASU 2022-06 does is it extends the sunset date. So most ASUs have like an effective date, and then after that date, you must use it. Due to the nature of reference rate reform, that ASU originally had a sunset date when you could no longer rely on the ASU to say, hey, there's no need to analyze whether it's a modification or if hedge accounting is still effective. And all ASU 2022-06 does is it extends that sunset date. And so now you can no longer apply ASU 2021-01 to any kind of modifications that occur after December 31st, 2024. And so those are the ASUs that are effective for private entities for this coming year end. Now, I'm going to talk about ASUs effective for public companies. And along the way, I'm also going to talk about some ASUs that I think you should try to early adopt because they're going to benefit you. All right. So moving on to ASUs that are effective for public entities. Again, that first asterisk, I'm only talking about ASUs. I'm not talking about the codification improvements that aren't going to change practice much, or any kind of ASUs that defer effective dates, or any kind of ASUs that compound on top of other ASUs. I'm just listing the main ASU underneath there. And so as you can see here, there's about 8 ASUs that are effective for public business entities. Now, of those, we've already talked about those in red here. So there's really only 3 additional ones to talk about, right? And then the last thing I want to kind of note here are these double asterisks and triple asterisks here. And that is, again, just like when I talked about private entities, some ASUs they differentiate public entities between those that are SRCs and those that are not SRCs. And so as you can kind of see in the asterisks, some of these might not be applicable to your entity if you're an SRC. So the first one that we're going to talk about is ASU 2018-12, okay? This ASU is a big change for insurance companies, and it relates to long duration contracts, such as contracts that are non-cancelable or guaranteed renewable by the insurer, such as most life insurance and annuity contracts. So under the traditional long duration accounting model, premium revenue would be recognized when due, and a liability for future policyholder benefits would be recorded and measured as the net present value of estimated future policy benefits less the present value of the estimated future premium, right? So the net amount they think they're going to have to pay out, right? And so before ASU 2018-12, the original assumptions that were used to measure this liability for future policy benefits, they were locked in at contract inception, right? And they were held constant over the term of the contract unless there was a loss recognition event. Now, because they were locked in, the liability measured would include a provision for risk of adverse deviation. So what does that mean? It basically, it's adding a level of conservatism because you don't know what the future holds. And so it was usually a percentage or a dollar amount above the best estimate of what that policyholder liability would be. It's a fudge factor, basically, right? And then the rate that you would use, the discount prior to this ASU, would be an unobservable discount rate. It would be the rate that is based on an insurance entity's expected investment yield on its invested assets. So for those of you who might not know, most insurance companies, they collect premiums, they invest those premiums in assets, and they hope that the money they earn from their investments will help more than cover any kind of payouts that they have to make. And so now, after ASU 2018-02, an insurance entity is required at a minimum to update these assumptions at least annually and to update the discount rate at each reporting period, right? So they no longer are held static, these assumptions. And in addition, the discount rate is no longer this unobservable discount rate that's based upon an insurance entity's expected investment yield on its assets. Instead, it should be an upper medium grade or low credit risk fixed income instrument, like a single A rating, right? That should be what the discount rate should be used to discount this liability for future policyholder benefits. In addition, any kind of change in the liability as a result of these, changes in assumptions that we're making at least annually, they're going to run through the net income, except for any kind of change that's due to your discount rate. That would run through your other comprehensive income. But that's not the only thing that this ASU changed. Again, this is a pretty big ASU for insurance entities. In addition, ASU 2018-12 changed the following, right? So the first bullet here, a market risk benefit is a contract that both provides protection to the contract holder from capital market risk, and the corollary, it obviously exposes the insurance entity to that risk. So before 2018-12, there were kind of two different measurement models for market risk benefits. But after 2018-12, insurance companies are required to measure all market risk benefits at fair value. Moving on to the second bullet. Insurance companies, they'll usually defer contract acquisition costs. And before 2018-12, there were multiple amortization methods used in practice. After 2018-12, insurance companies are required to amortize deferred acquisition costs on a constant level over the expected term of the related contract. Moving on to the third bullet point, right? This one deals with shadow deferred acquisition. That's what DAC stands for, deferred acquisition adjustment. So what are shadow DAC adjustments? Well, most insurance entities classify many of their debt securities as available for sale. And available for sale investments are adjusted for fair value, but the unrealized gains or losses are put in OCI. And so codified SEC guidance, which is widely used by private insurers too, requires certain assets and liabilities that, per the contract terms, would have to be adjusted if those unrealized holding gains and losses were actually realized. So a lot of times, like life insurance policy liabilities, deferred acquisition costs, things like that, this codified SEC guidance would say that you'd have to make a corresponding adjustment to other comprehensive income for these available for sale debt securities. So your investments, they're marked to market with their changes running through OCI. And what this codified SEC guidance said is, well, now you also need to do the shadow adjustment by also changing the deferred acquisition cost and the policyholder benefit liability. You also have to adjust those as well as a result of any changes in your unrealized gains or losses on your investment. And that too would run through OCI. And so that's now eliminated now because we are delinking. ASU 2018-12 is essentially delinking the invested assets from the valuation of the contract liabilities and the amortization of your deferred acquisition costs, right? So it eliminates the need for these shadow adjustments because, as we mentioned on the previous slides, you're now going to be adjusting those assumptions on an annual basis at least. And then to the last bullet point, deferred annuities with guaranteed minimum benefits will move to a fair value approach to estimating the liability for those versus the current amortized cost method. The last big change that it makes is that now insurance entities are required to provide a disaggregated tabular roll forward of your policyholder benefit liabilities and other liabilities such as your deferred acquisition costs, right? And so each disaggregated roll forward must reconcile to your aggregate ending carrying amount. So the roll forward has to aggregate to and reconcile with whatever's recorded on the balance sheet. Lastly, you have to, as part of this roll forward, you need to either, as part of the roll forward or accompanying information, you have to disclose these items that you see here. And I'm not going to go over all of them into detail or anything like that, but needless to say, there's additional information that needs to be disclosed. Similarly, there's some more complex transition requirements. So I'm not going to go over them in detail. I just want to make you aware that, the transition requirements for this ASU are not your plain vanilla, retrospective versus prospective, that kind of thing. And that there's different transition requirements for your liability, the changes to the policyholder benefit liability and your deferred acquisition cost versus your market risk benefit. So there's some different transition requirements depending upon what the change is. And then I think the other thing I want to mention is, we talked about 2018-12, but it was amended by 2022-05, a slight amendment. And what that was is that, ASU 2018-12 in general requires a retrospective transition in general, right? As I mentioned earlier, it's a little bit more complicated than that. But the resulting stockholder feedback stated that, hey, applying this ASU to contracts that we de-recognized in the past because we sold them, right? We sold a policyholder contract or whatnot. it doesn't provide useful information to have to go back and remeasure it, right? And for example, an insurance entity might be required to reclassify a portion of previously recognized gains or losses from a sold contract that was sold, prior to the adoption date of 2018-12. And this would result in having an entity have to communicate, like, why did I previously recognize gains or losses, and why are those gains or losses changing now because I had to remeasure it, but I've sold this contract already prior to the adoption of 2018-12. So as a result, the FASB issued 2022-05, which amended the transition guidance and allows an insurance entity to make an accounting policy election. And that policy accounting election can be made on a transaction by transaction basis to exclude certain contracts that meet a certain proper criteria. And as you can kind of guess, the criteria to exclude it from applying 2018-02 would be that you had to have de-recognized that particular contract because of a sale or disposal, prior to the adoption date, and that the entity has no significant continuing involvement in that particular contract that was de-recognized. So 2018-012, it's effective for public business entities, excluding SRCs, for fiscal years and interim periods within those fiscal years beginning after December 15th, 2022, so this coming year end. And then for all other entities, it's going to be applicable for your 12/31/25 fiscal year end and interim periods within your 12/31/26 period. Early adoption is permitted. And so some insurance entities that are private might want to early adopt just because they know it's going to happen and they're going to have to adopt at one point in time or another and use a retrospective approach anyways. The next ASU is 2021-08, and this one deals with accounting for contract assets and contract liabilities from contracts with customers. So in other words, you have 606 revenue, and you have, generally it's deferred revenue that this affects, but you have contracts, assets, and liabilities that are recognized under 606, and you have a business combination, right? You acquire a company. And if any of you have experienced this before, when you acquire a company under 805, you generally measure everything at fair value. Well, the fair value of deferred revenue isn't necessarily equal to the carrying value. So the carrying value would be based upon how you allocate things under step 4 of the 606 5-step process. But the fair value of that liability would only be what it costs to reperform, right? That particular performance obligation. So sometimes when you have to defer revenue for GAAP purposes, it can create what's called lost revenue, where you had a company that you acquired and it had revenue on its books, deferred revenue, that you then mark the fair value, which generally is a lower value for deferred revenue. And so when you actually satisfy that performance obligation, you now only recognize the fair value of revenue, of deferred revenue. And so that's, you lose revenue there. And so people complained about that. And so now what ASU 2021-08 does is it requires an entity to recognize and measure contract assets and liabilities acquired in a business combination within 606. So you measure it just like you would at 606. It's not fair value, it's whatever you would measure it at 606. Now, generally, this is going to result in acquirer recognizing, measuring, and acquiring assets and liabilities at whatever they were recognized by the acquiree. I say generally because you have to obviously make sure that the acquiree was accounting for things in accordance with 606 properly for that carrying value to carry over to the new combined entity. Importantly, this does not apply to other assets and liabilities, right? Like refund liabilities or customer-related intangibles. It only applies to contract assets and contract liabilities that are related to 606. This is effective for public business entities for periods beginning after December 15, 2022. So in other words, this coming year end. And it's applicable for all other entities for fiscal years beginning after December 15, 2023. So next year, but this is something that you're going to definitely want to early adopt if you're a private company listening here, is because you don't want to have that lost revenue. And also it's just easier. You don't have to have a fair value determination for deferred revenue. You can just use whatever you would use for 606. Early adoption is allowed. And of course, you would apply it prospectively. And with that, let's talk about our third polling question here, which is, have you experienced lost revenue after marking acquired deferred revenue in a business combination, right? So again, lost revenue That's when, you have revenue on the acquiree's books. That's that carrying value, which is measured in accordance with 606. And before this ASU, you would then have to mark that at fair value upon a business combination under 805. And so what would end up happening is that you would end up, generally deferred revenue, the fair value of it is less than the carrying value. So you would reduce the carrying value on the acquiree's books when you move it over to the acquirer's books. And that reduced value, that amount would be what gets recognized in the revenue as you perform your performance obligations, right? And so that's why you would end up having that lost revenue. So hopefully everyone's had a time to answer that polling question and make sure they get their CPE credit. And so let's move on to the next ASU that is effective for public companies this coming calendar year. And that deals with fair value hedging, or the portfolio layer method. So this is something that is going to be most impactful to financial institutions, right? So in 2017, FASB issued 2017-12, which affected hedge accounting. And among many things, it made it easier to achieve fair value hedge accounting for interest rate risk hedges of a portfolio of financial assets, right? And so lenders such as banks, mortgage lenders, credit unions, they manage a large portfolio of fixed rate loans. But typically these assets are funded with floating rate liabilities. So this mismatch between fixed rate assets, the loans that they make, and the floating rate liabilities can cause an unwelcome earnings volatility. And so hedge accounting would mitigate this volatility. However, in order to apply hedge accounting, typically the maturity date of the item being hedged, for example, the fixed rate mortgage loan, right, to a bank's customer, would have to agree with the maturity date of the hedging instrument, like an interest rate swap. Now that creates problems when financial instruments are prepayable, like most fixed rate mortgages, and when there's multiple items attempting to be hedged, like a portfolio, right? And so 2017-12 introduced this last of layer method, right, which allowed entities to hedge a stated amount of a closed portfolio. That's that amount that was not expected to be prepayable. So this image here, you can imagine you have a portfolio of loans, and you have one layer where you say, okay, this is the amount we think might be prepaid, and so we can't really hedge it because we can't match the maturity date of when things are going to be prepaid with a swap. But there's a certain amount that we don't think is going to be prepaid, and that amount, that last layer, we're going to hedge just that last layer, right? And so following the issuance of 2017-12, the FASB received lots of positive feedback, right? And so that caused the issuance of 2022-01, which basically created what's now called the portfolio layer method. And so what that basically does, it expands the last of layer method that we just described to allow multiple hedged layers, right? So going back to the previous slide, that green amount right here, you might have multiple layers within that, right? So it expands that last of layer method to allow multiple layers. So now it's called the portfolio layering method, since it's no longer just one last layer. It expands the scope of the portfolio layer method to include non-prepayable financial assets. Third, it specifies that what specific hedging instruments are eligible for this method. Fourth, it provides additional guidance on the accounting for and disclosure of hedge basis adjustments. And fifth, it specifies how hedging basis adjustments should be considered when determining credit losses. And then the last big change that it does is it deals with held to maturity classification or reclassification to available for sale. So banks typically, they're going to hold a fair amount of debt securities that are classified as held to maturity. The ASU allows an entity to reclassify debt securities that would currently be classified as held to maturity at the date of adoption of this ASU. It allows them to reclassify them to available for sale, right? But you can only reclassify those debt securities if you're applying the portfolio layer method to that particular instrument. So that instrument is part of a closed portfolio that you're applying the portfolio layer method. Then you could take that instrument and you could apply the available for sale debt security classification. This is effective for public business entities for fiscal years beginning after December 15th, 2022, right? So this coming year end. And for all other entities, it's for fiscal years beginning after December 15th, 2023, so next year. But early adopt application is permitted. And because most people find this positive, I would suggest if this applies to your entity that you early adopt that. The transition requirements, they differ depending upon what the change is, as you can see on the screen here. So let's move on to ASUs that are effective for public business entities for this coming quarter end, okay? And a lot of these are going to be things that private entities are going to want to early adopt. So the first one being ASU 2020-06, and that deals with debt and conversion and other options. Now, what this does is it eliminates the BCF guidance, right? If anyone's familiar with that, it's kind of onerous. That's the biggest change that it does. The other big change that it does is it removes, if those of you are familiar with embedded derivatives, there's certain criteria that have to be met in order to account for something as a equity. And if it doesn't have those criteria, then it has to be recorded as a liability and marked to market. So certain of those criteria were removed. And the big change here that I've highlighted in orange here is that something that's hidden in this ASU is that it clarifies that a lot of private companies would say, my shares aren't readily convertible to cash, so therefore they don't meet the definition of a derivative. So therefore, I don't have to apply the guidance in 81540. What this clarifies is that whether or not you're a public company, whether or not your instrument meets the definition of a derivative, it should be remeasured at fair value if it fails either of the tests in 81540. So it means it's not indexed to the entity's own stock, and the settlement criteria it does not provide for any possibility of cash. So that's a potential big change for a lot of private companies that kind of got their get out of jail free card by saying, hey, my shares aren't readily convertible to cash, so therefore they don't meet the definition of derivative, and therefore I don't have to apply 81540. So this ASU, it's effective for all entities for annual periods beginning after December 15th, 2023. So that's why it's effective for Q1 public companies. And then it will be effective next year end for private companies. But this is something that you might want to early adopt simply because it's going to be retrospective adoption. And if you have BCFs, it's going to be a relief. It's going to help you. The next ASU is 2022-03, which is deals with fair value measurements of equity securities that are subject to contractual sale restrictions. So, a contractual sale restriction would be like a lockout agreement or something like that. And what this ASU does is it says, hey, when you're valuing that instrument, any kind of contractual restriction on the sale of equity should not be considered when you're measuring the underlying security. Right? So you would have no liquidity discount, right, for lack of marketability. The important thing here is that it hinges on whether the restrictions are characteristics of the underlying asset. Like, for example, if it's a 144 share, that's an underlying characteristic of the share itself, right? No matter who holds that restriction still exists. So if that's the case, you would still consider any kind of sale restriction and have a discount for lack of marketability. But if, say, it's just a lockout agreement, just particular to who the holder is, for example, an IPO and the shares that the entity holds from an IPO, then you would not consider that restriction on sales when you're measuring the fair value of the underlying asset. And it requires some additional disclosures you can kind of see here on the screen. It's effective for public business entities for this coming Q1, and it will be effective for all other entities for fiscal years beginning after December 15th, 2024, right? But again, this might be something that's early adoptable. It's going to be something that you might want to consider early adopting. The next ASU that we have here is 2023-01. And this one deals with common control arrangements and leases, right? So you have a common control lessor leasing to a common control lessee, right? And what it does, it has some changes that are only for private companies and then some changes that are for all entities. And the big change here is that, a lot of common control leases have either unwritten terms or terms that have expired, that kind of thing. And what it clarifies is that if you have a common control lease, then as a practical expedient, you can consider only the written terms and conditions, not have to consider what's legally enforceable. If you have no written terms for the lease and the entity has not documented the unwritten terms, so the kind of hint here, which is, if you want to avoid having to consider your legally enforceable terms, you might want to document, even if it's not a written lease, maybe have a contemporaneous documentation of the understanding between the common control lessor and lessee. And you can apply this on a lease by lease basis, right? So you just look at the written terms. Now, the change that's applicable to all entities is the leasehold improvements. And that is, if there's a common control lessor owns an underlying asset, then you would amortize that leasehold improvement that the lessee has. You would amortize that over the useful life of the leasehold improvement, right? If the common control lessor leases that underlying asset from, say, a third party, then the lessee would have to amortize that not to exceed the life of the lease, right? And then leasehold improvements should be accounted for as a transfer between entities under common control, right, through an adjustment to equity when the lessee no longer controls the underlying asset. So when the lease ends and it reverts back to the common control lessor, you can account for it as a transfer. And that's effective for all entities for fiscal years beginning after December 15th, 2023, and early application is permitted. That moves us to our polling question number 4, which is, does your entity have any kind of leases with common control entities? We'll give people a few seconds here. So yes, that will help a lot of common control leases, especially those that are like month to month and that, maybe don't have terms that are at market, that kind of thing. Well, hopefully everyone's had time to answer this pretty simple polling question here. So let's move on, just for the sake of time here, into some of the other ASUs. This is ASU 2023-02, which deals with accounting for investments in tax credit structures using a proportional amortization method. I'm not going to go into depth on this one because it's very niche. But what I will say is that for low-income housing tax credits, there was this method called the proportional amortization method, right? And a lot of investors like that. And what this ASU did is it basically just expanded that method to say, hey, you can apply that method to other tax credits that aren't just the low-income housing tax credit. That's basically the gist of what it did, right? And it gave you some criteria in order to meet that. So what the other tax credit would have to meet in order for you to apply that proportional amortization method. And this was effective for public business entities for periods ending after December 15, 2023. Early adoption is permitted, and because it was so well received, I anticipate if this does impact your entity, you're going to want to early adopt it. And then we're going to talk a little bit about these are the issues you should early adopt. You should consider early adopting, and the only one here that I think might be a worthy of discussion is the one on joint ventures, right? And so what that basically is ASU 2023-05. And what it basically said is there's a lot of diversity in practice when a joint venture was created. Like, how should the joint venture itself account for contributed assets and liabilities? And what it basically said is the joint venture itself should account for assets and liabilities at fair market value, like an 805 transaction. Now, the investors in the joint venture still account for everything under the equity method, but the joint venture itself should measure it at fair value. And that oddly could create goodwill because the fair value should be the joint venture's 100% of their equity, not the sum of the fair value. So it's possible that you have goodwill because the overall fair value of the joint venture is greater than the sum of its parts, right? It requires certain disclosures. It does not change, as I mentioned, disclosure or the accounting for the joint venture by the actual investors itself. They should continue to account for things under the equity method. And of course, that's not effective yet, but you probably want to early adopt it just because it's a clarification as to what the AICPA wants you to do. And with that, I just want to finish up by thanking everyone and also just introducing our last polling question here, which is if you're interested in speaking with anyone here about any of the things that I've talked about. Again, many ASUs have 1 hour. Can't go all in depth on all of them. I tried to focus on the ones that I thought would be most impactful. But if you have any questions, we're happy to help. Whether you're a client of ours or not, and if you're an insurance client of ours, we can also help to a certain degree. So absolutely, we're here to help you if you like. And with that, I think my time is up. So we had just enough time here. We'll release the ASU polling a question here, the results of the polling question. And if you have any questions that you want to email me, particularly, this is my email address up here. If you had any questions that were in the chat, I'm going to receive those after this webinar. And so I will respond to those via email as soon as I can. So again, thank you, everyone. I appreciate it. A lot of material to go through. Hopefully you learned something. Thanks so much. Bye.